Okay, I'd just like to introduce Chariot Oil and Gas. We're an exploration company focused on the Atlantic margins. We have assets in Morocco, Namibia, and Brazil. And what I'd like to do is to take you through a description of the portfolio. I will be making forward-looking statements, and this is the context for those statements. Why invest in Chariot? For us, the most immediate trigger is the drilling of the Rabat Deep-1 well, which will be spud in the first quarter of next year. It's targeted for March. That individual prospect is a 77 million barrel prospect to Chariot, which in and of itself, in the success case, would be transformational. FinCap assigned 29p a share in the risked basis on that prospect, so in excess of a pound in the success case. Our current share price is in the region of 16, 17p. So that individual prospect in and of itself is transformational. It sits in acreage where there are 6 additional prospects, so they would be de-risked. So we've got material running room and upside in that portfolio. But also we're protected in the downside. In that license, we originally partnered with Woodside, who paid for the seismic, and we've now partnered with E&I, who are operating the well with the Saipem 12,000, which is the unit you can see on the slide. And so at this point, we are zero cost in Morocco, so we're fully carried in that asset. As a company, our cash significantly exceeds our commitments. And I think the important thing for us is that we're trying to build a conveyor belt of assets. We're looking to drill 3 wells within the near term, and we're targeting very large prospective resources. So Rabat Deep-1, 77 million barrels. We're also looking at Prospect S in Namibia, 300 million barrels net to the company, and the Kenitra well in Morocco, 350 million barrels net to the company. And partnering is underway on those second 2 assets. So what do those prospective resources mean? These are the prospects that we're targeting: Rabat Deep-1 on the left, S in the middle, and Kenitra on the right, with some of the follow-on prospects that are immediate below them. The graph below shows this drilling inventory of prospective resources against the 2P reserves of LSE companies that you'll be aware of. Now, it's important that prospective resources are not 2P reserves. Prospective resources are the estimate of the volumes that could be discovered versus proved and probable in a development that's underway or that will be in development. But Rabat Deep-1 in the success case is equivalent to the 2P reserves of Ophir or Cairn. So that individual discovery could create a company of that scale. Prospect S is equivalent to the 2P reserves of Tullow. So our net share of S has that scale and capacity. And Kenitra has the prospective resource that's equivalent to the 2P reserves of Premier. So we are elephant hunters. We're swinging for the big one. Any of these could be genuinely transformational to the company. Why now? Well, Chariot, we're targeting these 3 wells in the near term. But I think also an important thing, as you've seen with the cycle, the oil price cycle, is that costs are at an absolute historic low. So 2.5 years ago, rig rates were at $650,000 a day. They're now less than $200,000 a day for a deep water unit. We drilled wells, 2 deep water wells in 2013, both of which were over $80 million. Those wells in Namibia, those wells could now be drilled for $20 million. So the costs have absolutely significantly reduced. And there's going to be activity both in Namibia and in Morocco, so we can also see potential additional savings because of synergies that we can affect. I think the important thing that we've got a sense of is that there is a return to exploration being undertaken by the super majors, the majors, the people that we're looking to partner with. And this is because of the stabilized oil price, $60 a barrel currently, the cost environment that's now calibrated to that, but also reserve replacement. The top graph shows the FID volumes and the discoveries that have been made. Last year, the world discovered less conventional oil than it had for the previous 60 years, which is beyond my time and certainly beyond almost everybody's time in this room. So we have not been discovering the volumes that are required. And the bottom graph is a superimposition of that curve on BP's production description. Last year we produced 33 billion barrels of oil into the market, and we discovered less than a tenth of that. So there is a significant delta, and it's that reserve replacement that the super majors and majors are being driven by that create the market for us, for our partners. Our portfolio is a deep water portfolio. We've got a range of play types and a range of countries and a range of water depths, but our water depths are shallow deep water. They're from 750 meters up to 1650 meters in the three prospects that we're looking to drill in the near term, and they're in benign metocean conditions, normal pressures, normal temperatures. So they're at the low cost of exploration exposure, but also low for appraisal and development. All of the things that we're targeting are potential elephants, so very large prospective resources in new and emerging countries which have very attractive contracts. So if you take low cost multiplied by large volume, multiplied by great contract terms, it means that our assets are very high margin assets. Our projects have break-even oil prices of between $20 and $25 a barrel. In Morocco has some of the best commercial terms in the world. So we now have a portfolio of drill-ready assets that we will be drilling, that we're working through with our partners. Capital discipline is essential for every company. It is even more essential for an exploration company. Over the last 4 years, we've actively ensured that we manage our capital in a very effective way. We started with a cash balance of $68 million. In that period, we've invested over $100 million in our portfolio, so we should have a significant negative number. But our cash position at $21.7 million is a testament to the success that we've had in partnering, where we have recovered more than $40 million from parties that have come in, and those parties will be carrying us through forward programs and a small fundraise. Another part that we've really focused on since the new executive team has come in is to have a laser-like view of G&A. Our G&A is reduced from $9.5 million to less than $5 million. We've halved our G&A during the course of that period because we want our capital to be invested in exploration and not in the corporate burn. Here are the triggers within the portfolio. This shows the scale, the scope, and the breadth of the operations that we have, and the delivery of our strategy. We are zero cost in Morocco, where we will be drilling the Rabat Deep-1 well in January. We have no remaining work program commitments. All of them are satisfied other than that well, and that well is fully carried by Eni, who will be operating that well. And our aspiration is to undertake these additional two wells to give us 3 wells within the near term, because we're looking to keep that conveyor belt going. We're also actively involved in new ventures. We're looking to access additional acreage of the same scale, size, and opportunity that we're currently involved in to keep that conveyor belt going. The important thing within our portfolio is any success in any part of the portfolio liberates huge potential in the remainder of the acreage in which that discovery is made. In the central blocks, we've got 5 prospects, one of which we'll be testing. If that one is successful, at 300 million barrels, it liberates 1.4 billion barrels of prospective resource in the rest of the portfolio. So in summary of the investment thesis, we're an Atlantic margins explorer, and we have the portfolio of a major. We're looking for giants, and the assets that we have are high margin assets. This portfolio is drill ready, and we're focused on risk management within that portfolio. That risk management comes through the quality of the technical work that we do and the G&G that we supply, but also in the partnering programs and processes that we're involved in. Our cash exceeds our commitment, so we're in a very secure place as a company, and we have a variety of internal and third-party triggers that are going to be happening round about our portfolio. We're focused on delivering these 3 wells in the near term, one of which is fully funded and will be starting in March of next year. And any success in any part of the portfolio opens up material running room in the adjacent prospects in acreage that are controlled by Chariot. We have a booth, so if there's any specific questions, we'd be more than happy to take those. Thank you very much.